market is not saturated yet, and this could trigger another leg up. It could be triggered by three different sources: interest rates, recession risks, and geopolitics. And if you have a look at the general sentiment in capital markets at the moment, it seems like, Goldilocks all over. Everything is fine. The Federal Reserve has done a tremendous job in, killing inflation and not killing the economy.
Ronald-Peter Stoeferle returns to the show. He is the managing partner of Incrementum AG. He and I last spoke in January of this year when the gold price was trading around $2,000 an ounce. Ronald said back then it would go higher. Well, it has more than just gone up. It has breached new all-time highs, surpassing $2,400 an ounce at one point, and now at $2,360 as we speak on the 3rd of July. We can revisit that call, by the way. If you check out the link down below in the description box, you can watch Ronald's last interview with me and see what he said then. Well, Ronald today is calling for the gold price to go much higher still. He said this bull run is not over, so we're going to go over his year-end outlook as well as his multi-year 20-30 year outlook. Hint, it's much higher. We're going to find out why. We'll also be talking about the new In Gold We Trust report 2024 edition. Ronald, good to see you. Welcome back to the show.
Thanks for having me, David.
Ronald, you're a good person to get gold price predictions from because you're a fund manager as well as a researcher, which puts you in the position of getting real-time fund flow information on a daily basis. So I'd like to start by asking you about your gold price prediction for the intermediate term, and then we'll go over your longer term 2030 outlook later on in the interview. Starting with your outlook first, we'll talk about the assumptions later.
Absolutely. Thanks, David. So the title of this year's report is the New Gold Playbook, and the team and I, we sat together a couple of months ago and said, well, actually, real interest rates are rising. We're seeing positive real rates now, and still the price of gold is making new all-time highs. We're seeing that the Western financial investors, which can be gauged by gold ETF demand. The Western financial investor is selling gold. We've seen 850 tons of outflows in the last 2 years from the gold ETFs. We're seeing that the average allocation to gold in the Western world is ridiculously low. So the question is, what has changed in the gold market? Why are those rules and laws that used to work previously, why don't they work anymore? And I think one of the main reasons is actually that in this new gold playbook, central banks have become a decisive factor in the demand for gold. So more than 1,000 tons of gold being purchased by central banks starting in 2022, then again in 2023, and Q1 2024 seems as we're making new records again. This is basically the reason for this the weaponization of fiat money and its consequences. But then we're also seeing that I would say that the Western financial investor isn't the marginal gold investor anymore. So I think we in the Western world, we tend to underestimate the importance of emerging market gold demand. And, by 2024, emerging markets will produce more than half of the world's GDP, while in the year 2000, it was only 19%. And of course, as Louis Vincent Gaff once said, gold is a low beta proxy for emerging markets. So 65% of global jewelry demand and 50% of investment demand, physical investment demand, is now coming from China, India, and the Middle East alone. And I think this is really being vastly underestimated in the Western world.
Okay. In your report, you've stated that you anticipate gold to hit 2665 by year-end 2024, so second half of the year, and then a further appreciation to about $4,800 by 2030, so end of the decade. Let's talk about the intermediate trend first before we talk about the long-term trend. And this chart basically just shows a curve going up into the future. Intermediate term, we have 2655. That is still higher than the previous all-time
Yeah.
high. And we talked about macro factors. It's interesting because real interest rates have been going up this year. The inflation rate has been coming down, and at least in the U.S. And the dollar has maintained its strength. These are headwinds for gold traditionally, yet gold has still managed to propel itself to 2,300, 2,400. So my question is, what's going to push it to another $200 higher?
First of all, David, I think it's important to say that we're in a bull market, and we're seeing classic early bull market action. So the miners start leading and outperforming the price of gold. We're seeing that silver kind of also is starting to outperform gold. The gold silver ratio is trading at 77 now. We have broken this gold silver ratio trend line to the downside. So it really seems that the strength of this bull market is pretty strong. June normally has got a very weak seasonality. Actually, gold was flat. Gold was trading at 1,800 in October, end of October last year. Now we're trading roughly at 2,350. So it seems that there is really so much capital waiting on the sidelines, and everybody is buying into every major every minor dip. So that just tells me that this bull market is extremely healthy. We're seeing as kind of a 10-week gold correction, but it's basically a sideways correction, which is also a pretty positive sign. Now, the question that you've asked is, okay, what could push gold higher? From my point of view, it is Western financial investors that are still a missing part of the puzzle. We're still seeing net outflows from the gold ETFs year to date. So that's kind of telling me that the market is not saturated yet, and this could trigger another leg up. So why could the demand from the gold ETFs actually change? The World Gold Council put out a great piece yesterday where they said this actually it could be triggered by three different sources: interest rates, recession risks, and geopolitics. And if you have a look at the general sentiment in capital markets at the moment, it seems like Goldilocks all over. Everything is fine. The Federal Reserve has done a tremendous job in killing inflation and not killing the economy. But I think nobody is really having those risks discounted in his assumptions. So that might be a trigger going forward. And I think for the longer term, we will still see those major central bank buying programs. They will continue because central banks in the emerging markets have got a significant lower share of gold of their overall FX reserves compared to industrial nations.
Before we continue with the video, I'd like to tell you about the precious metals sector. Now, gold, as you know, hit record highs in 2024. So the question on everybody's minds is, what should we be following and tracking in relation to gold? Well, I'm here to tell you that Stellar Gold is a name to watch. Stellar is a leading gold developer with two cornerstone gold projects in Canada: the Tower Gold Project in the prolific Timmins mining camp, and the Kalamak Gold Project in the Northwest Territories. The company has a massive global mineral resource estimate, one of the largest in Canada for a gold developer. Its young and ambitious management team, with a track record of success, is aggressively advancing its projects and is determined to unlock significant value. If you're looking for a team who is as enthusiastic about gold's future as you are, then check out stlrgold.com/David Lin in the link down below, or scan the QR code here, where David Lin viewers can sign up for their macro gold newsletter to get inside knowledge and updates for free. Are you not concerned that with interest rates coming down, and you're in Europe, for example, the ECB just cut rates not too long ago, with interest rates coming down, gold has even more competition from bonds for the Western investors?
Not really. I think that this asymmetry of central bank policy that we're seeing is also probably a driver for the price of gold. What do I mean by that? Well, actually, central banks, not only the ECB but also the Federal Reserve, they have been extremely slow with realizing that inflation is actually legit, and it was called transitory, and of course Russia was being blamed for the surge in inflation, but they reacted way too late. Now we're still seeing inflation rates above 2%. And they're kind of panicking, and the ECB already lowered rates, which is, from my point of view, against the law, and therefore I think it's at some point it might be some sort of a confidence problem for the ECB. And I can tell you, we were talking before about the euro, and I said I'm pretty devastated because of the results yesterday at the euro. And you said, well, what happened to the euro? I said, no.
I was wondering how long it would be until football comes up. It hasn't been even 7 minutes yet, but yes.
And by football, I mean soccer, right? I was talking about the soccer tournament and not the euro, the currency. But still, as I've said before, I think that inflationary risks are everything but contained, and I think there are so many inflationary drivers going forward: deglobalization, demographics. We're seeing, if there's like one thing that unites the left, the right, and the central populist politicians in the US, but also especially in Europe, it's probably the demand for income redistribution, very much in favor of low and middle income earners. We're seeing this, this struggle that results from that between wages and profits. That's a classic formula for wage price spirals. We're seeing this swing in the direction of militarism, even in countries like Germany, in Japan, in Sweden. We're seeing rising defense spending. We're seeing all those inflationary drivers that would suggest to me that, as we have said previously, the great moderation is over. So we might be in for another leg up in inflation, and this will be the point in time when the market realizes that the emperor has no clothes, and that would put enormous pressure on the ECB, but also on the Federal Reserve.
Put pressure on them to what? To maintain higher rates?
No, I think to make a U-turn, because if they start lowering rates, and yesterday it seemed like that Powell was hinting a rate cut in September. And I have to say, I mean, if you would have told me, like at the beginning of the year, where the market expected 7 to 8 rate cuts for 2024.
Yes.
And now we're seeing 1, perhaps 2 rate cuts, I wouldn't have expected gold to hold up that well. I think that's a sign of strength. However, I think the market wants and it needs lower rates. But if that goes hand in hand with higher, or let's say the next leg up in inflation, of course, that's central banks will have painted themselves into a corner at that point. So that's a threat that I'm seeing for the medium term.
Medium term, you're still bullish on inflation. Is that the summary?
Yes.
For both the euro area and the US. Here's a counter argument for why gold matters here. All throughout last year and into this year, we saw the rate of inflation, which is to say the rate of change of prices, come down, right? In the U.S., it was 9.1% at the peak, and now it's much lower than that, not quite at 2%, but about 3%, still much lower than 9%. The trend has been down. We're starting to see some deflationary pressures in grocery items, some at some stores like Target, Amazon, big stores cutting prices on groceries. So the trend remains down for inflation. However, like we mentioned, gold has gone the other direction. It's gone up. So the counter argument here from the people who don't believe in this thesis is, why does gold still matter for inflation? Gold no longer behaves as a counter-inflation hedge. It moves in the same direction. When inflation goes down, it goes up. And in the past couple of years, when inflation has gone up, during 2022, gold has actually stayed flat. So the question is, why does gold still matter as an inflation play?
That's a great point that you're making. And I think we really have to differentiate between the driving factors from the Western world and emerging markets. As I've said before, I think that really emerging market physical gold demand is now the driving force between this move in gold. And so the question could be, and I hope that answers the point that you're making. The question could be, why are we still seeing falling ETF holdings when real interest rates rise in the Western world? And I think the assumption basically is that Western financial investors are not exposed to increased counterparty risks. And therefore, there's no need for a default proof asset. And, bonds are fine. Of course, now yields are juicy again, but defaults aren't the risk at all. I think the second point would be that real interest rates will remain positive in the future, and the second wave of inflation will not occur. I think that's very, very much the general sentiment in the market at the moment. And the third would probably be that they suffer opportunity costs if they underweight traditional asset classes, such especially equities and bonds, or even real estate at the expense of gold. And the question is, if those three main assumptions, again, from the typical Western financial investor, if that could change. So counterparty risk, real interest rates remaining positive and not seeing another wave of inflation. And the third one would be opportunity costs from equities and bonds. From my point of view, that could change. And this would probably be the next, that would trigger the next leg up in gold. If Western financial investors should realize, okay, well, perhaps we should have a little bit more than like 0 to 1% exposure in gold.
That's a good segue here. In your 2024 report, you wrote that this research found that a 16 to 19% allocation of gold in a portfolio maximizes risk-adjusted performance. Our calculations show that the integration of gold into an equity bond portfolio has a clear positive impact on the Sharpe ratio. Well, that makes sense because gold here reduces the volatility, therefore increasing the Sharpe ratio. So my question is, if the optimal portfolio allocation is around 16 to 19%, why is it that most family offices and funds allocate 2% to gold, 5% maximum is what I've heard in a lot of funds?
I don't know. I mean,
they haven't read your research. That's the answer I was looking for.
we tried to do our best to make a sober and solid, fact-based case for gold. And we've got a chapter about the marketing or the image problem of gold in the Western world. I think it's not an asset that especially institutional players really enjoy having or enjoy buying for several reasons. It is very much, many people think that if they buy gold, that also is confirming the view that everything will go to hell, that we will see hyperinflation, civil war, and the end of the world as we know it. From my point of view, it's not, and there's this safe haven gold demand, but then there's also this performance gold demand, and as I've said before, if we say that gold is actually a play on the rise or the growth of emerging markets, and there's several studies that we that we cite in the report that say, okay, with higher disposable income in emerging markets, actually gold demand is just rising. So if we say, okay, this is the positive case for gold, that might make a change. As I've said before, so far in the Western world, allocations to gold are totally insignificant. And there are many private banks coming out now and say, yeah, based on our views, one should own like 2 to 3% gold in your portfolio. I mean, we crunch the numbers, and actually 2 to 3% doesn't make any difference from a portfolio point of view. And therefore, we've crunched the numbers, and we're analyzing the impact on the Sharpe ratio and so on, and come up with this optimum gold allocation. Now, that also means that from our point of view, and this was one of the key takeaways, we think that we should move from the old 60-40 portfolio, which was basically 60% equities and 40% bonds, to a new 60-40 portfolio, because the main premise of the old 60-40 portfolio was actually coming from 40 years of low inflation volatility. So actually from this time of the great moderation, if our assumption is correct that the great moderation is over and that we'll see more inflation volatility, then I think everybody should kind of reconsider the portfolio allocations.
This is the new 60-40 according to the new report. You have stocks 45%, bonds 15%, so stocks plus bonds.
Yeah.
Equals 60%. And the other 40% you have gold. And it's just interesting because you've differentiated safe haven gold, so I guess bullion gold,
yes,
15%, and then performance gold, which I believe is just gold stocks, right? Mining stocks, 10%.
Also silver, yeah.
Also silver, okay. Commodities, 10%, and Bitcoin, 5%. We'll finish off on Bitcoin in just a bit. Performance gold, so why have you differentiated, I guess, gold stocks? Well, let's take silver out of the equation, but gold stocks, you're not putting in the stocks category?
Yeah, because I think that I think it's if you buy gold or considering a new allocation to gold, I think you have to ask yourself what is your motive? Do you really want to hedge against worst case scenarios, or do you want to just make a performance? We talked to many institutional players, many family offices, and actually safe storage of physical gold, avoiding counterparty risk, moving their gold holdings to several different jurisdictions, different continents. This is really, it has become a big thing probably because of this loss of trust in, politics, the rule of law, whatever. But I think this, what we call safe haven gold, this is really something where the price actually doesn't count too much. This is really like a worst case hedge. But then if you say, I want to make performance, I think that the price of gold is too low. I don't think that we'll see the end of the world. Of course, there will be hiccups, but I want to buy gold and make some performance. Then you can buy mining stocks, you can buy the gold and silver mining space, you can buy silver, you can use leverage, whatever. But I think it's really important to differentiate between those two different motives. And after being in this space for almost 20 years and managing funds that include gold for almost 10 years now, and losing, lots of hair in that process, because it's probably the most complex asset class that you can imagine. The most top-down asset class is probably gold and silver mining. And our assumption is that gold stocks aren't a long-only asset class. It's not something where buy and hold works. It has to be timed very, very actively. So we created this active aurum signal that is basically telling us, okay, now you got to play offense, now you got to play defense. So this is our view. Now at the moment, that's probably going to be a next question. Now we're really all in. We're taking leverage. We're buying into the small cap space. But there will be a time when we will get out of the market or play more defense, buying more the large caps or the royalty space, or even bonds from the mining space. But now I think it is time to play offense also in the gold mining space.
Because you think the miners have not caught up to gold price yet?
Yes. I mean, the HUY, the gold box index, was trading in, I think, 2011 at almost 600 points. Now we're trading at 270. Of course, there was quite a lot of dilution. So they've been inflating their share count quite aggressively. But I think, there's tremendous opportunities in the mining space out there, and I really look forward to the Q2 numbers. I think most of the analysts out there are way too bearish. I really expect tremendous amounts of free cash flow being produced, and I think that at least the companies that we follow, they really learned their lesson, and they're still very, very cheap.
It doesn't look great for the gold miners when gold has had such a huge rally and the miners up until the last month have been underperforming. For investors, we think, well, why can't I just invest in the metal, right? Because that is leverage in itself. The miners are just putting operational risk in front of the metal. How would you respond to that? How would you convince investors that perhaps there's still leverage for the miners yet?
Well, David, I did quite a lot of keynotes recently, attended conferences, and there was one particular conference, lots of private bankers, institutional players, and I can tell you, at breakfast, coffee, during lunch, dinner, and at the bar, they were all talking about one stock, NVIDIA. And I think, we know it's the world's most valuable company now at 42 times sales, I think. This is pretty much unheard of for a very, very cyclical semiconductor stock. The market cap now is roughly 3 trillion, which is 10 times as much as all the gold and silver miners in the world. So from my point of view, as long as we're seeing this bull market in US tech, which is only being led by one company anymore, I think that the gold mining space will continue to have a hard time. But I think at some point we will see that
Rotation,
the numbers are excellent. I would call some mining companies even deep value plays at the moment. And as Naval said, be right when everybody is wrong at scale. And I think you can now really find potential 5 to 10 baggers without taking too much risk in the mining space.
Well, yeah, I mean, according to your portfolio allocation, you're not going all in on mining stocks. Performance gold is 10% of the portfolio.
Yeah.
So, okay, Ronald, let's talk about the economy. So we have a situation where, yes, the Asian investors, Chinese in particular, according to the World Gold Council, they bought 68% more gold in the last year than the previous year, according to investment demand flows. This is largely due to the fact that, well, the Chinese economy is not doing well. As you know, there's a real estate crisis going on. Youth unemployment is high or rising. Actually, a lot of the gold came from younger people, gold buying, who want to protect against their future. This same chaos is not here in the West, at least not yet. So my question is, what in the economy, what economic factors will potentially drive Western investors to buy gold with kind of the same mentality as the Chinese last year?
I think, for China, obviously there's not too much other opportunities and to invest. Real estate has been the premier choice for Chinese investors, and we're seeing now that the cash holdings in China are at a record high. So the Chinese household cash holdings, that's like 108% of GDP. So it's pretty significant, and I don't think that the Chinese gold demand will collapse going forward. It could take a breather from my point of view, as we're seeing now with the third plenum, which will be in July. I think there will be quite some measures to stabilize the real estate market, to stabilize the economy. And I'm actually pretty confident regarding the Chinese stock market, I have to say. Anyways, talking about the Western world, I would say that, the elephant in the room is obviously debt. Since year 2020 in the US, an additional 11 trillion in debt has been accumulated. And I think for the US it's 35.3 trillion. That's 125% of US GDP. Now, coming back to Europe, if you remember, the beginning of the Euro crisis, 2009, 2010, for the sake of comparison, Greece, right before the Euro crisis started, was at 127% debt to GDP. Of course, the Greeks couldn't print their currency, but still. So my point would be, at some point, I think that will start to matter, and I'm not really sure if this very, very aggressive fiscal stimulus that we're seeing in the United States if that's really sustainable. And of course, I mean, we've got an election year coming up, but having a look at this fiscal dominance that we're seeing, not only in the US but all over the globe, basically, especially also in large parts of the Eurozone. I think this is vastly being underestimated as an inflationary driver. I think that was really one of the major changes starting in 2020 with the COVID crisis. So a debt crisis, not in emerging markets, but rather in industrialized nations, I think that could really be a trigger for the gold market.
Let me just interject here. BIS, the Bank of International Settlements, came out with this report. This was reported in the Wall Street Journal just 2 days ago, July 1st. Headline is Rising Government Debt Threatens Financial Stability, Inflation, the BIS says. The Central Bank for Central Banks warned that rising debt levels expose governments to the risk of a crisis similar to that which roiled the UK in 2022. This is from the report. Markets could, at some point, question fiscal sustainability, head of the BIS economic department said in a press conference. We know from experience that things look sustainable until suddenly they no longer do. In the annual global report, the global economy, according to this report, it said that rising debt levels exposed governments to the risk of a crisis similar to the UK when investors suddenly shied away from government bonds, driving borrowing costs up sharply, weakening the currency, and sending equity markets into a tailspin. This is the sequence of events that they're projecting could be a risk. Could you respond to that?
Yeah, I mean, I can only confirm what Nassim Taleb, probably one of the smartest guys out there, recently said. He said a U.S. debt crisis is a white swan. So not a black swan, but a white swan, something that will happen 100% sooner or later. Now, obviously, if we compare it to the UK, and I was actually in London during that time, that was pure panic when the UK gilt market completely broke down. Can it happen in the US? I think yes, but it will take it can go on for longer than we all think. However, what's going to be the US budget deficit for 2024? The fiscal year 2024 is 1.6 trillion. That's roughly equivalent to the total GDP of Spain, which is the 15th largest economy in the world. I think US debt payments or interest payments, if we stay at the same interest rate level like currently, will be 1.7 trillion next year. What's the US GDP? I think it's 24, 25 trillion. So those numbers are really significant, and therefore, from my point of view, it's just a given. I'm 100% sure that at some point the Federal Reserve will have to step in with. I don't know if it's going to be called QE again, or if they come up with a new fancy term and abbreviation. But something like that will have to happen at some point. And just look at Japan. That's like the monetary end game, and I think we're following the Japanese.
Well, let's talk about Japan right now. The yen has been weakening. It's at 161 to the dollar. Do you think that if the Bank of Japan intervenes at some point to prop up their currency, they'll have to sell some other assets like treasuries. Would that have any significant impact on the U.S. Treasury market? Have you looked into this?
It could, but of course, I mean, there's a very strong alliance between Japan and the U.S. and very close ties between the Federal Reserve and the Bank of Japan. I actually don't know. I think that 160 is kind of the line in the sand, and we're kind of considering going long. Not as a trade from a technical point of view. I think it's a pretty interesting risk reward. But the best trade probably is basically being long the gold in Japanese yen terms. I mean, that's like the perfect chart, yeah. And if you have a look at the numbers, and I mean, the Japanese yen is still the third largest currency. Gold year to date is up 30% in Japanese yen terms. It was up 21% last year. It was up 15% in 2022. So this basically tells you that gold is just doing its job. Yeah, it's protecting you from monetary aggressiveness, from inflation. It's just a very, very decent fiat money hedge, and that's just the primary role of gold, and I think it's playing that role pretty well.
Just as an aside, based on the numerous conversations you've had with people at conferences, clients, so on and so forth, have people shifted their sentiment to gold from a safe haven hedge play to a more risk-on asset? I mean, it's been climbing alongside stocks. Good correlation with the S&P this year. Good correlation with tech stocks. Good correlation with Bitcoin. If you just came from Mars, you look at the chart for the last year, you think this is a risk-on play.
Yeah, I don't know what if I came from Mars, what if the first thing that I would think about would be gold and correlations. There are other things to wonder about in this world, but I can tell you, and again, this might be anecdotal evidence, but of course, if people approach me, they want to hear my view on gold, and I can tell you, if I tell them that gold is actually pretty cheap at these price levels because of at an inflation adjusted basis, gold is still far away from its all-time highs. Yeah, silver even more so. Most people kind of start ridiculing me, and most people would say, okay, or would ask me, now is the time to sell gold and not to buy gold. Mm-hmm. So I think we're far away from any how did Greenspan say
irrational
exuberance, yeah. And just have a look at the CPF function on Bloomberg. So the analyst consensus by the big names on Wall Street for 2026, the median estimate for gold is $2,000. For 2028, it's 1,700. So I don't see too much bullishness out there for gold in the Western world again. And that makes me pretty relaxed, I have to say.
Let's move on to the long-term projections. You're projecting more than $4,000, right? 4,800 rather, US by 2030. Again, that's, many years from now. Actually, not even too long. What year are we? Oh boy, that's not even that too long from now. 6 years from now. I feel like I'm still in the mid 2000s. Okay. Well, what are the assumptions you're making here for the longer term forecast?
Well, David, we were publishing that forecast in our 2020 report when we made a long-term outlook for this decade. And we said it could be a golden decade, actually. And remember where the price of gold was trading in the year 2020. So we said $4,800 based on our monetary model that we explained at length in the 2020 report. And $4,800, that sounds like quite a lot, but that's annualized from now until the year 2030. That's 12%. And I think that isn't really outrageous. Now, I think one important thing, David, if you remember the like the previous big bull market. You remember the great financial crisis. Were you already in the market, if I may ask, during that time?
Where the 2008?
2008, 2009.
I was in high school. I was playing video games. I was
You're that young?
I was not participating in the markets. What do you mean? Am I that young? I'm old now. 2008 was a long time ago, Ronald.
No, because you're so smart
Oh,
and you
thank
know
you.
everything. So I thought you probably have been in the market already back then. Anyways,
I
um,
was looking at we were looking at paper trading in school. And a funny story, we had an assignment where we had 1 month to do whatever we wanted with $10,000 of virtual money. So I had no idea what the stock market was. So I called one of my mother's friends who's a stockbroker. I said, "What should we do for 1 month?" He says, "Well, maybe you should buy something that's most volatile or something that is very volatile." And actually, what we did was we just bought oil futures for 1 month. I don't think we did very well. This was 2008, so we did not do well. But anyway, that was my experience with the markets. If you ask me.
no, but if we go back to that time, actually, I think that gold broke $1,000, which was the big psychological barrier in March 2008 when Bear Stearns went down. So actually between January 2008 and September 2009, gold was flirting with this $1,000 level.
Mhm.
And then we've seen the breakout, and actually it took us 2 years to almost double. So we were consolidating for 2 years, then the big breakout, and then the price of gold doubled to 1920 in summer 2011. Now, if we compare it to the current picture, let's not forget that gold was flirting with that $2,000 level for almost 4 years. So that was like a pretty long and cumbersome consolidation that we saw. Now we broke above that, and I think could we see gold doubling over the course of the next 2 or 3 years? Hell yes, definitely. Um, Again, our forecast is $4,800 at the end of this decade, but you know how those models work. But and therefore, if it's going to be 4,800 or 4,500 or 5,000, I think what really counts is that we're in a bull market. And I said at the beginning, it is classic early bull market action. And if we compare, and therefore I just really enjoy traveling to emerging markets, and I will go to Saudi Arabia in January. I will be in China again. I was in Dubai last fall. Dubai is responsible for 25% of global gold trade nowadays. So if you compare the mentality, the gold mentality, Western world versus emerging markets, I think this really adds to your insights and, or let's say, understanding of the gold market, because those people in China, in India, in the Mid East, for them gold is just something natural that they save. They don't really invest or trade in gold. They just save in gold. For them, topics like de-dollarization, which has become a topic in the Western world as well, that's just normal to talk about if you're in Dubai, or in Saudi Arabia. I mean, it's gonna happen at some point, yeah. Um, and I think therefore this makes me pretty relaxed regarding gold going forward.
Well, let's finish off on another asset, Bitcoin. So you have in your 60/40 portfolio 5% allocation to Bitcoin. I was just thinking if I were to repeat that same high school exercise, 1 month allocation to something, it'll probably be something in the crypto space. I don't even think Bitcoin is volatile enough. But anyway, I digress. My question is, do you think the 5% allocation will increase or decrease or change in the future for you?
It could increase. I think that we started writing about Bitcoin, I think 8 years ago in the In Gold We Trust report. We've got two funds that actually combine gold with Bitcoin. we got lots of hate, both from the Bitcoin world and also from the gold world. Gold is super emotional. And Bitcoin is also extremely emotional. There's no gray area. There's just yes or no. There's nothing in between. From my point of view, both are just very, very hard monetary assets. One is a teenager and the other one is around for 5,000 years. Gold market cap is 15 trillion. Bitcoin is 1.3 trillion. I think, for both have a very, very high stock to flow ratio. And for Bitcoin, for example, 95% of all Bitcoin is already mined. And by 2023, 99% of all Bitcoin will already be mined. So we're seeing absolute scarcity in Bitcoin. And therefore, I think that, in a world where, monetary inflation, very high debt, and financial repression, geopolitical issues going on, I just think that you want to own some scarce assets with very, very low inflation. And the one is, is being influenced by the code, and the other one by geology and mining. And I think there's no reason to not combine those two assets and to be that emotional. And I think that those those emotions in investing, they're probably not the best. How do you say? Being emotional is not something that you want to be as a prudent investor. So I like gold. I like Bitcoin very much. I think that over the course of the next couple of years, Bitcoin will probably outperform gold. The ETFs have been a huge milestone. Many people are a little bit disappointed by the performance of Bitcoin recently. I just think that after the halvings, 6 to 18 months after the halving, this is really the sweet spot for Bitcoin. So this is still that's going to happen or start basically in fall. And yeah, therefore, I as I've said in a previous interview, you can have like a big SUV, like a Range Rover or whatever in your driveway, but also a Ducati motorcycle. Why not own both?
You'll get hate from the Ducati crowd for saying that, probably. Comparing us to a Land
Probably
Rover.
from the from the Harley Davidson crowd. Yeah, the
Yeah,
Hells
probably.
Angels are gonna visit.
Final question. Do you ever see a day where Western central banks, I'm not talking about El Salvador, I'm talking about Western central banks would adopt gold and take it in their reserve? I spoke to some ex-central bankers. The attitude is no, 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 we will not do that. But, they were in the previous generation. What about the future?
You mean adding Bitcoin, not gold?
Yeah,
Central
did I
banks.
say gold? That's what I meant.
Yeah.
Adding
Bitcoin.
Adding Bitcoin.
Yes, I think we're seeing this adoption already happening in the corporate space. And the next big milestone would obviously be in the central bank space, but that's not going to happen in the next 2, 3, 4 years probably. And it will start with rather small countries, El Salvador, perhaps Argentina, I don't know. But I don't think that the Deutsche Bundesbank will start buying Bitcoin or the Swiss National Bank very, very soon. But at some point, definitely yes.
Okay. Thank you very much, Ronald. Very thorough update on the world situation and gold. Where can we learn more about your work?
Thanks, David. That was fun.
Yeah.
Well, you can download our In Gold We Trust report. It's 420 pages, so it's a long read, but we're getting tremendous feedback from all over the globe, and we're already working on the 2025 report. You can download it totally for free on our webpage, ingoldwetrust.report. There's also a compact version, which is still 40 pages. We've got monthly chart books on gold. That's the Gold Compass. We just put out our In Gold We Trust special for the Independence Day in the United States, showing the purchasing power of gold measured in gasoline. Gold protects your purchasing power, not only in gasoline, but also we talked about the gold beer ratio, for example, at the Oktoberfest. So we've got all sorts of different publications. You can download everything totally free of charge on ingoldwetrust.report. I'm pretty active on Twitter. My handle is at Ron Stoeferle. And if you want to learn more about our investment solution, our investment funds, our wealth management, it's incrementum.li.
I just want to say, if I came from Mars, this would be the top of my reading list, just to learn about the world.
Thank you very much, David. Appreciate it.
So, yes, please do check out In Gold We Trust report. Links down below. Ronald, good to see you, and better luck next time for Austria in the Euro. And we'll speak again soon.
The next big tournament is going to be the World Cup 2026 in Canada, the US, and Mexico. So I'll be there.
Okay, yeah. Please
Thanks
hit
a lot,
me up.
David.
Bye-bye.